Sunil Subramaniam joins us. Sunil, not once, not twice, but this is like, as long as markets have existed, we know that trading is something which on a longer term basis does not create wealth. It only destroys, gives you stress, and it has an impact in terms of the total positioning of somebody's wealth. So if the data point is against retail traders, why is this activity still growing?
Because I like the fact that you called it activity and not investing, as many people make the
Words
mistake of
carefully.
saying,
I
right?
chose my words carefully. SIP is investing, trading is activity.
Exactly. And this is a gambling instinct in people coming to Nikon. That's very clear, right? It's just that in the absence of lotteries, in the absence of casinos across India, this is a vehicle for people to dabble in a gambling kind of instinct. So, and then when you look at it from that perspective, right, in gambling, the house always wins, the casino always wins, the lottery provider always wins. So it's nothing unusual about that. And the reason for that is that of these losses that we talk about, right? It's not that every single action or activity is a loss. They make money, sometimes they lose money. Obviously, on the balance, they lose much more. But you ask any to a gambler, the more he loses, the more he bets. That's the essence of gambling. That can I get that one big trade which will wipe out all my existing losses? That's the human nature, and really saying you can't go against it. Now, if in that context you look at this, two things are there, right? One is SEBI's actions have been consistent in highlighting this and trying to make things simpler and reduce their chances of losses. So about 20 lakh people actually have stopped this activity. I think from 60 odd lakh, it's down to 41 odd lakh. So that's great, because at the margin, that's almost 27 to 30% people have actually, I would say, got scared or at least learned their lessons. So it's a move in the right directions. Maybe next year you will see this come down more. That's one. The second aspect is you can't forget the Jane Street matter. So while on a normal course, the odds are loaded heavily against retail, what worsened the situation over the last couple of years is the fact that there was, I don't know whether you want to call it pump and dump, definitely index price rigging, and the way the whole thing came through, right, has contributed to this. So now actions, and I know the investigations have not stopped with just the one player, other such HFTs are being also examined. And I think that would help. So next year's data should hopefully see not only a reduction in the number of people because of the fear element, but probably we will see that the amount of losses will gradually trend down. And my final point here, Nikon, is to say that we all tend to treat these people as the bad sheep, as the black sheep, saying, oh, they are coming only with like I said, but this is the human nature. And second is they provide vital liquidity to the market. So overall, as a market, the problems are arising because overall our market is still a developing country market. We are not yet a developed market where there's adequate liquidity across. And so I think that these retail activity players are doing a job for the overall market infrastructure by providing liquidity. Yes, you need to make it safer. You need to make them aware of the kind of risks they're taking. You need to make them aware that you can't take higher bets to make up your earlier losses, that there has to be risk management at your end. And even there, there's probably some kind of advice that you can take from stock market brokers in how you play the game. So rather than just throwing out the baby with the bathwater and say, no, go this way, I think educating them, financial literacy is obviously key. Educating them, ring fencing the market, and making sure the regulator is going after the bad apples in the institutional side. And I think all of these are steps in the right direction. So though the 91% people proportion losing, it's a lesser number of people. And obviously those who remained are the inveterate gamblers. So that's why the losses per person and the absolute losses has now gone into 1 lakh crore. So to that extent, right, I think SEBI will be even more probably taking some actions, but some of these actions are very recent. So we need to wait for them to play out. But I always see all of this as indicating that we have a very good regulator who is proactive, who is willing to take actions against big institutions, and has been cautioning the retail investors about this. I think there's limited more the regulator can do, but they're doing an excellent job. And I'm sure that over a period of time, you will get much more of retail people not just doing this activity from a gambling perspective, but looking at it as that's where I think the AMC industry and the mutual fund distributors have to look at this. You have more than two times the number of demat accounts as you have unique MF folios. So target these people, teach them the basics of investing and say there is risk, but you can get reward by diversification and expertise. So I think everything is steps in the right direction. Will probably take some time to get there. But as a developing market, these are the teething troubles. These are the developmental issues that any developing market will face. And we have to go through this pain for the ultimate gain of having a healthy, well-regulated and deep capital market.
But Sunil, one observation, the loss number has actually come down in the fourth quarter. Perhaps it could be because of the curbs on weekly expiries as well, which was ongoing in the fourth quarter. What else do you think can the regulator can do to try and curb this temptation of the activity in the terminology?
So I think one thing that I'm currently based in Singapore, and so there's Marina Bay Sands, which is the gambling thing there, casino here. And you know what they do? They actually tag people who have made a lot of losses, and they ban them from entry. Okay, because they are doing this out of that addiction, right? So I think one of the things is all these people are ultimately trading through brokers, right? And the brokers are regulated by SEBI. So I think SEBI has to act through the brokers to tag individual investors, see the nature of their activities, and if they are taking like throwing larger bets to recover losses and do, they should curb them. They can probably restrict those kind of retail traders from putting even more money, because if you go back, I'm not sure their family knows that they're throwing so much at the table here. So I think that regulatory mechanisms have to through regulated entities, and that's where I think the broking houses have an important role to play. Whether the regulator forces them through regulation or they themselves do this as a part of a healthy capital market is up for debate. But I think that's the only way we can do this, is that the people who are actually advising, and fin influencers are again another big set of people who are influencing these people, right? So I think regulating the fin influencers, regulating the broking houses to make sure that the ultimately retail customer, right, is taught about risk and reward, and not just saying, oh, there's a huge potential for reward here, which is what typically fin influencers and others are doing.
Well, indeed, Mr. Subramaniam, SEBI has been trying to get some guidelines out there as well. We have been hearing about it. But other than that, help us understand that what more from a regulator point of view they actually do to curb this kind of a participation from the trader side. The reason I ask this because equity penetration in India is still in the single digits compared to some of the developed nations, while the number of traders, that's seeing a significant and an exponential growth rather.
So I would not say that I would actually object to that happening, right? You see, as you expand the capital market penetration, you're going to get a lot more people come in. And the reasons they come in as an activity as opposed to investment, right, is the challenge, right? So financial literacy is the one where I think SEBI has to, just as the mutual fund industry has set aside 2 basis points, of which 1 basis point is used by SEBI through AMFI to advertise about the good parts. I think even at the broking houses, some amount of money needs to be taken by SEBI and a huge financial literacy campaign. See, ultimately, you got to make people enter the capital market in the right way. Right now, what's happening is that they are entering through demat account and equity, and then some of them are coming through to the mutual fund industry. So I think education is the long-term fundamental thing, but curbing these people coming in, I'm not sure is right, because like I said just before, they provide a healthy liquidity to the market, number one. Number two, this is a legitimate way for them to play their gambling instinct out, and that's human nature. So you temper it, you control it, but you don't ban them from entering. So I would not encourage lesser number of people coming in. They come in, but come in with guardrails. Teach them how to come in. So obviously for me, financial literacy is absolutely top of the pie in terms of what they do. And second aspect is that when they come in and they make these losses, I think the level of individual tracking of the way people are trading, right? I think today SEBI has phenomenal AI related tools, and that's how they've discovered the Jane Street thing, and that's how they're going to go after other similar players. So I think they can apply that kind of an AI tools to understand investor behavior. How does a person come in? He makes a first loss, then second loss. Does he learn from it? Does he still take bigger bets? How does he do? And so there's an emotional and a behavioral aspect to this on the behavior of the people, where also some literacy and education needs to be done. So I would say that as a regulator, what they are doing in terms of going after the big institutional HFTs who are trying to rig the price of the index or the options is one aspect. Second aspect is tightening this by, like I say, reducing the number of trading days, making sure the exchanges align on the same day. That's the second, which is a very good option. But the third, ultimately, is that you have to balance getting more people into the capital markets versus they're coming in the activity base rather than investment base. There are
All
no easy
right.
solutions here, but I would actually say that we need to increase equity participation.
Fair
So
point.
you can't help that, right?
Fair point. Enjoy stay in Singapore. Hope to see you soon. And thank you very much for joining us.
Thanks.